So today we're going to take a moment and we're going to talk about the risks and benefits of buying a home using seller financing. Now, whenever you're buying a home using creative financing such as this, the seller is going to have certain inherent risks, and as the investor, we may have some as well. Now, if you haven't had the opportunity yet to check out our How to Buy a Home Using Owner Financing videos online, there's going to be a link that pops up that you can click on and listen to that as well as we go through this. So let's take a minute and talk about what is an owner finance transaction when the investor is buying it from the seller. Now, in most instances, there's going to be an existing mortgage in place, meaning there are two ways that you can buy that. You can buy it subject to the existing mortgage, meaning that that mortgage is going to be left in place, and you're going to agree to start making those payments on behalf of the seller. Or in some cases, you may buy that property using a wraparound mortgage, which is where there's a new note and deed of trust between the investor and the seller. Now, those terms can be the identical terms of the underlying loan. They could be different, and oftentimes they are for a bit more money. But once you've decided how you're going to buy that property, the basis of the transaction is the seller is going to convey the ownership to the investor using a deed. The investor is going to give back to the seller either a deed of trust to secure performance if they're buying the home subject to the debt, or they're going to give the seller back a note and deed of trust if they're doing a wraparound mortgage. Now, as this is progressing, you may buy the property just for the amount of the existing debt. Maybe the investor and seller have negotiated some type of a down payment along the way. Maybe there's a note involved between the investor and the seller where the seller is getting more of their equity paid out in monthly installments that can be negotiated however the seller and the investor so chooses. But when all this is completed and the transaction is closed, the investor owes the homes, the investor owes the seller any monthly payment and or the mortgage company the monthly payments going forward. So it's important to note that as you're entering into this transaction, make certain that you are prepared to make those monthly payments whether or not you have the property income producing. So often investors buy these homes, the homes are vacant. Maybe it takes several months to either complete repairs or get it marketed and occupied. So be prepared to make those monthly installments along the way once you close the transaction. So as we go through this, let's just talk a minute. What are some of the risks that the seller may run into that the investor may want to discuss with the seller as you're negotiating the transaction? So the benefits for the seller, of course, are they get a chance to sell the home, and oftentimes they sell the home much quicker than traditional mechanisms. And so often in our situations, the seller may be in a distressed scenario, facing foreclosure or needing to move imminently because maybe they have relocated, bought another home, and they can't afford to make two payments. There's, of course, a myriad of reasons of why those things occur. But being able to close quickly is obviously one of the benefits of seller financing. It allows the seller to oftentimes get their loan reinstated if they're behind and in foreclosure and stop the foreclosure process. Oftentimes, if the home is not in good condition, the investor, once they buy the home, is going to renovate that home, which means that the collateral that the seller has is going to be improved. So the seller is going to gain benefit from all of those items once the investor buys the home. Oftentimes, the seller can sell the home as is without making repairs. And so often in our marketplace, as I said earlier, our sellers are in distress. They have an imminent need in order to sell the property, and the investor comes in and helps to solve that problem on their behalf. So let's take a moment now and talk about what the benefits are to the investor buyer buying this home using creative financing. So first and foremost, of course, it allows the investor to close the transaction oftentimes much quicker. It allows the investor to take over, in most cases, an existing mortgage that has a much longer term on it. It has a much lower interest rate, meaning a much lower monthly payment. And of course, doing so with limited to no financial risk. Of course, the risk is that the seller holds the deed of trust, meaning that if they don't perform and don't pay the monthly payment, then of course the seller could foreclose on the property. But otherwise, it's a great opportunity to take over this asset and this commodity that the seller has out there of this existing mortgage with limited liability. Now remember, if you're signing a wraparound mortgage, you are signing a new note and deed of trust, and whenever you're doing that, you're actually taking on liability that time. But it's the ability to take over this existing mortgage in some format without having to go to your bank or mortgage company to get financing, usually with less money out of pocket along the way from your down payments, etc., that makes the benefits to the investor buyer in creative financing. So now that we have talked a little bit about the benefits to the seller and the investor buyer using owner financing, let's take a minute and just touch on the risks that a seller and a buyer may incur when using some type of creative finance in selling and buying the property. So first off, what are the risks to the seller? Well, there are two primary risks they incur. One is the continuing liability on the existing debt, and of course the second is the due on sale clause. So keep in mind, guys, that when the seller is allowing you to buy their home subject to the debt or providing you a wraparound mortgage, they are basically lending you their credit in that scenario. You're taking over their mortgage and agreeing to make their monthly payments. And just because you've agreed to do that doesn't mean you can't just not make the payments. What you really want to strive for is buy the property and be prepared to make those monthly payments every month, even if you don't have the property income producing yet. Always try to keep in mind our goal is to protect the seller at all costs. Second is the due on sale clause that is in most mortgages. And sellers sometimes don't understand this, and our goal is to make sure we describe it to them properly so they get over the hurdles of what that may be and what could happen. So remember that a due on sale clause there's nothing illegal about it. It is simply a breach of a simple contractual provision of a mortgage. And I always like to ask simple questions. What is it a mortgage company wants? They want their monthly payments. Do they really want to own this house? No. And oftentimes that allows the seller to get over the issues they might have with due on sale and understand these kind of things, because that truly is what goes on with a mortgage company. They are there to make a loan and collect payments. They are not in the real estate business. And those are primarily the risks that a seller may have. The only other risk that they might incur is in the event that the investor defaults. They could have to go through a foreclosure, which is a possibility, hopefully not. And if they do foreclose, there could be an eviction process. Maybe they have some cleanup work to do to the property. Every deal is going to be a little bit different. So hopefully those things never occur. So what are the risks that the investor might come across in a seller finance transaction? And so primarily it is the due on sale clause is the primary risk that the investor is going to occur. So of course what we want to do is understand it and navigate it properly to put as many things in place to dissuade the mortgage lender from foreclosing using their due on sale clause as possible. And of course, the best ways of doing that are making your payments on time, handling your insurance in proper mechanisms. And those are the primary risks that I think the investor are going to run across. So now that you understand some of the inherent risks that a seller has and a buyer has with seller financing, there are other mechanisms to ensure better operation of an owner finance transaction. And that, of course, is the incorporation of a loan servicer. And this is where the investor or buyer would make a monthly payment to the loan servicer. And of course, the servicer then would pay the underlying mortgage company. If there's any monies left over being paid to the seller, maybe it's through a second lien mortgage or through a wraparound mortgage, then those payments would be paid to the seller direct. Now, you don't have to use a loan servicer in acquiring the home. It is an option that's available. We usually use a loan servicer when the investor is selling the home using a wraparound mortgage to a back-end home buyer. But it certainly does not mean that you cannot utilize a loan servicer. Take a minute and check out the Owner Finance Network's OFN loan servicing on our website if you're looking for a good loan servicing company. There'll be a link down below that you can click on to get access to their contact information as well. So if you found this video helpful and you're looking to expand your real estate investing career, head over to our website at theownerfinancenetwork.com, where you can check out our many owner finance programs that go in depth all about owner financing and the various strategies that they incorporate. If you guys like this video, take a moment to like us and leave a comment below on other videos you'd like to hear us produce. We'll see y'all next time.